90 miles. That's the distance between Havana and Key West. On a clear day, a fast boat can cross it in under 3 hours. A commercial jet crosses it in 25 minutes. 90 miles separates a nation whose per capita GDP is somewhere in the same neighborhood as Haiti's from the single richest large economy that has ever existed. That gap, 90 miles wide and 66 years deep, is the subject of this documentary. Not because Cuba is unusual. Poor, isolated, mismanaged economies are not rare. What's unusual is why Cuba is poor. This isn't a resource curse story, or a drought story, or a corrupt strongman looted the treasury and fled story, although parts of all three are in here. This is a story about what happens to a country that gets cut out of the global financial and trade system for 2/3 of a century, and then loses the one lifeline it had left, almost overnight, because of a decision made 4,000 miles away in a different country's capital. By the end of this video, you'll understand why an island with pristine beaches and a highly literate population produces almost nothing anyone wants to buy. You'll understand why Cuba's electricity grid is now failing in a way that has nothing to do with hurricanes or heat waves. And you'll understand something bigger than Cuba itself, what happens, financially and economically, when a country's survival depends on a single foreign patron, and that patron disappears. Here's where we're going. First, we're going to unpack the plumbing of the Cuban economy. Not the politics, the plumbing. How does a country actually stay solvent when it's locked out of the world's largest capital markets? We'll look at the two invisible currents that kept Cuba afloat for decades: remittances and tourism, and why both of those are far more fragile revenue streams than they look on a balance sheet. Second, we're going to trace the domino chain that took Cuba from chronically poor to what the UN and outside economists are now calling a full-blown humanitarian emergency. A chain that starts, improbably, with a US military raid on a presidential palace in Caracas. Third, we'll get into something most coverage of this crisis skips entirely: the balance sheet mechanics of a currency devaluation, and why a technical, boring-sounding monetary reform in January 2021 did more damage to ordinary Cubans than most hurricanes ever have. And finally, we'll look at Cuba's answer to all of this: a package of 176 economic reforms passed in June 2026, the most sweeping liberalization since the revolution, and ask the only question that actually matters for investors, migrants, and Cubans alike. Is this the start of a Vietnam-style opening? Or is it something else entirely dressed up to look like one? Everyone knows the word embargo. Almost nobody thinks about what it does mechanically to a country's finances. A national economy runs on a simple loop. You sell things to the world, you get hard currency back, and you use that hard currency to buy the things you can't make yourself: machinery, medicine, fuel, spare parts. Break that loop, and it doesn't just mean fewer imported cars. It means a country slowly loses the ability to maintain anything it already built, because maintenance itself requires imported inputs. A power plant doesn't fail because someone forgot to switch it on. It fails because the specific turbine bearing it needs was manufactured by a company that, thanks to sanctions law, is not allowed to sell to Cuba, and the substitute part from a friendlier supplier doesn't fit. This is the part outside analysis usually glosses over. An embargo is not primarily about denying a country goods. Cuba can, in theory, buy plenty of goods from Canada, the EU, or Latin America. What the US embargo actually restricts is dollars, access to the currency that 88% of global trade is still invoiced in, and access to the correspondent banking relationships that let any of that trade clear. When Congress extended the embargo extraterritorially in the 1990s, threatening penalties on foreign firms that did business with Cuba, it wasn't really targeting Cuban exports. It was targeting the willingness of banks, Spanish banks, French banks, Canadian banks, to touch a Cuban transaction at all, because none of them wanted to risk their far larger US business over a comparatively tiny Cuban one. That's the same mechanism, incidentally, that keeps Iran and North Korea financially isolated today. And it's why sanctions on countries with small economies are disproportionately effective compared to sanctions on countries with large ones. Russia in 2022 had enough gravitational pull, oil, gas, wheat, that much of the world kept trading with it anyway. Cuba, with an economy smaller than that of a mid-sized US metro area, has no such gravity. When the world's largest financial system tells its banks, "Don't touch this," there is no offsetting force large enough to keep those banks in the game. So if the front door to global trade is locked, what do? You find a patron rich enough and ideologically committed enough to subsidize you directly. Cuba has now done this twice, and both times the same failure mode eventually caught up with it. The first patron was the Soviet Union, which for 3 decades effectively ran a parallel economy for Cuba, buying its sugar at inflated prices, selling it oil at discounted ones, and covering roughly a fifth of Cuban GDP in the process. This is worth sitting with for a second, because a fifth of GDP being externally subsidized is an extraordinary number. It's the kind of dependency ratio you'd associate with a small Gulf monarchy living off a single oil field, except Cuba wasn't extracting a resource, it was extracting geopolitics. The moment the ideology-driven buyer disappeared in 1991, so did a fifth of the economy, and Cuba's GDP fell by more than a third in 3 years. That's a bigger single-country GDP contraction than the US experienced during the entire Great Depression. The lesson from that first collapse should have been obvious. Never again build your energy security around a single political patron. Cuba built the exact same structure again anyway, this time with Venezuela. The Chavez-era oil for doctors arrangement, launched in 2000, was elegant on paper. Venezuela had oil and needed healthcare infrastructure. It couldn't build fast enough domestically. Cuba had a surplus of trained medical personnel and needed fuel. At its peak, this deal supplied close to 100,000 barrels of oil a day, essentially all of Cuba's energy needs, in exchange for tens of thousands of doctors, teachers, and security personnel. Here's the financial red flag that should jump out at you immediately, the same one that shows up in corporate finance whenever a company becomes overly reliant on a single customer or supplier: concentration risk. If one counterparty represents nearly 100% of a critical input, you don't have a diversified supply chain. You have a single point of failure wearing a supply chain costume. Analysts who cover corporate credit risk flag this constantly. A retailer that gets 90% of its inventory from one supplier, or a supplier that gets 90% of its revenue from one customer, is priced as a fundamentally riskier credit, even if current cash flows look fine. Cuba, as a sovereign, carried exactly that kind of concentration. And sovereigns don't get to diversify away geopolitical risk the way a company can diversify suppliers. And the warning signs were flashing for years before the crisis actually hit. Venezuelan oil production had already been declining steadily, and the volume flowing to Cuba had fallen from that 100,000 barrel peak down to roughly 15,000 barrels a day by 2025. A collapse that was already well underway before anyone in Washington fired a shot. Cuba wasn't blindsided by a sudden shock. It was already running on fumes and simply hadn't hit empty yet. Then, in January 2026, the US military captured Venezuelan President Nicolas Maduro in a raid on his compound in Caracas, flying him to New York to face narco-terrorism charges. Whatever you think of the operation's legality or wisdom, and it has been sharply contested on both counts, its second-order effect was immediate and brutal for Havana. Venezuelan oil shipments to Cuba stopped almost overnight, and Washington moved quickly to make sure no one else filled the gap. Mexico's state oil company briefly stepped in, then pulled back once tariffs were threatened against any supplier caught shipping fuel to Cuba. A Russian tanker eventually made it through, the only one to fully deliver, per Cuban officials. But by June 2026, estimates put the reduction in Cuba's energy imports at somewhere between 80% and 90% relative to before the crisis. This is the point in the story where cause and effect collapse into each other almost comically fast. A US military raid in Venezuela triggers an oil cutoff in a different country, which triggers blackouts, which triggers the failure of water pumping, garbage collection, hospital equipment, and food distribution, all within a matter of months. That's not really a story about oil. It's a story about what concentration risk looks like when you zoom out to the level of an entire nation's infrastructure. Every one of those failing systems, water, garbage, hospitals, food, was electricity dependent, and every watt of that electricity depended on a fuel supply chain with exactly one working link. Here's where we bring in a concept that shows up constantly in infrastructure and utility investing: capacity utilization versus nameplate capacity. A power grid's nameplate capacity is what it could theoretically produce if every plant were fully operational. What actually matters for keeping the lights on is available capacity. Plants that are fueled, maintained, and functioning right now. By early 2025, before the oil ran out entirely, only about a third of Cuba's installed power capacity was actually available on any given day. 2/3 of the system was sitting idle, corroded, or waiting on spare parts that sanctions and a lack of hard currency made nearly impossible to source. This is a crucial distinction for understanding why the crisis didn't feel gradual. A grid running at 34% availability isn't a third as reliable. It's operating with essentially zero margin for error. Any single additional plant going offline, any spike in demand, any disruption to the remaining fuel supply doesn't get absorbed by spare capacity because there isn't any. The system was already teetering before Venezuela's oil disappeared. The oil cutoff didn't push it off a cliff so much as remove the one thing still holding it up. And notice where the money had actually been going while all of this decayed. Cuba had been allocating roughly 32% of national investment to tourism and only around 12% to energy infrastructure. That's a capital allocation decision, and it's worth judging the way you judge any capital allocation decision: by what it reveals about incentives. Tourism generates visible hard currency quickly, in a form the government can capture directly through state-owned hotels. Grid maintenance generates nothing visible in the short run. It just prevents a future disaster. Governments, like companies with short-termist management, routinely underinvest in maintenance because maintenance has no ribbon-cutting ceremony. Cuba's leadership bet on the asset that produced photogenic returns and let the load-bearing infrastructure rot, and when the external shock came, there was no buffer left to absorb it. If you want to understand how a government can make a bad economic situation dramatically worse using nothing but a single policy memo, look at what Cuba did to its own currency in January 2021. For decades, Cuba ran two currencies simultaneously: the Cuban peso, used for wages and domestic goods, and a convertible peso pegged 1-to-1 with the US dollar, used for tourism and imports. This dual system created bizarre distortions. State enterprises could book imported goods at a fictional exchange rate that made inefficient production look profitable on paper. Unifying the currencies was, in principle, sound policy. Most economists agree dual exchange rate systems eventually need to go. But the execution is where the real lesson sits. Cuba devalued its currency from that 1-to-1 peg to 24 pesos per dollar in a single stroke. Picture what that does to any business, state-owned or private, that imports anything. A $200 shipment that used to appear on the books as 200 pesos now costs 4,800 pesos overnight with no transition period. Every enterprise in the country was suddenly facing costs 24 times higher in local currency terms and had no choice but to pass that straight through to consumers. This is a textbook illustration of a concept every macro investor watches closely in emerging markets: the pass-through effect of a currency devaluation on domestic inflation. In economies that import a large share of what they consume, and Cuba imports most of its food, a sharp devaluation doesn't stay contained to the import bill. It ripples through wages, rents, and every downstream price almost immediately, and it hits hardest in countries where the population has no dollar savings to cushion the blow. Contrast this with how, say, a country like Vietnam or China managed currency liberalization gradually over years with capital controls calibrated to avoid exactly this kind of shock. Cuba did it in a single afternoon on top of a population that had just been hit by COVID's collapse in tourism and remittances. The result was triple-digit inflation that erased whatever savings ordinary Cubans had managed to hold on to. The takeaway that applies well beyond Cuba: a currency reform that is directionally correct can still be catastrophically executed. Being right about what needs to change doesn't protect you from being wrong about how fast to change it. For years, two revenue streams kept Cuba's economy from fully seizing up: remittances and tourism. It's worth understanding why both were structurally weaker than they appeared. Remittances, money sent home by the Cuban diaspora, flow somewhere between $1 and $3 billion a year into the country. Depending on which GDP estimate you use, Cuba's official figures put GDP around $100 billion, while outside estimates from groups like the Inter-American Dialogue put real output closer to $14 billion. That range represents anywhere from 2 to 3% to roughly a quarter of the entire economy. That's an enormous discrepancy, and it matters because it tells you something about how unreliable Cuba's own official statistics are as a starting point for any real financial analysis. When a government's own GDP figure and an independent estimate differ by a factor of 7, you're not looking at a rounding error. You're looking at a state that has strong incentives to overstate the health of its own economy, and outside analysts who have to reconstruct the real picture from fragments. What remittances have in common with tourism revenue is that neither is a productive export. Neither one reflects a country building something the world wants to buy. Both are essentially transfer payments. One from family members abroad, one from vacationers paying for an experience, flowing into an economy that produces very little of tradable value itself. That distinction matters enormously for resilience. A country that earns hard currency by exporting semiconductors or automobiles has revenue tied to global demand for its productive capacity, which tends to be somewhat sticky even during downturns. A country that earns hard currency from remittances and tourism has revenue tied to the discretionary generosity of relatives and the discretionary travel budgets of foreigners, both of which evaporate instantly the moment there's a shock. Whether that shock is a pandemic or a diplomatic crisis, tourist arrivals and remittance flows both dropped sharply the moment COVID hit, and GDP fell more than 10% in a single year, the worst contraction Cuba had seen since the Soviet collapse. Now overlay the 2026 sanctions campaign, which has specifically targeted the payment rails that make both of those lifelines function, pressuring Visa and MasterCard to cut off card payment services in Cuba, and sanctioning the military-run conglomerate known as GAESA that controls the hotels tourists actually stay in. You're not just cutting the flow of money anymore. You're disabling the pipes the money used to travel through. If there's a single name that comes up again and again in any serious analysis of why Cuba's crisis is so hard to resolve, it's GAESA, Grupo de Administración Empresarial S.A., the Cuban military's business conglomerate. GAESA is estimated to control somewhere between 40% and 70% of Cuba's formal economy. Hotels, retail chains, import monopolies, ports, and the foreign currency flows that pass through all of them. This is a structure worth understanding on its own terms, because it isn't unique to Cuba. Military-run conglomerates that dominate a national economy show up in Egypt, in Myanmar, in various post-Soviet states, and they share a common feature. They blend state ownership with total opacity, making them almost impossible for outside investors or outside sanctions regimes to cleanly target. That opacity is precisely why the June 2026 reform package, Despite being described by some Cuban economists as the most sweeping liberalization since the revolution, leaves GAESA essentially untouched. The reforms open the door to private banks, foreign investment without joint venture requirements, and larger private enterprises. But they don't restructure the military conglomerate that already controls most of the assets any serious foreign investor would actually want. Independent economists studying the reforms have pointed out something worth sitting with. GAESA has spent the past several years quietly transferring control of retail chains, import businesses, remittance processing, and trade banking into ostensibly private sector hands. Hands that, in practice, remain connected to the same networks of political power. One analyst studying the shift described the resulting opacity as making Cuba's private sector resemble Delaware, a place famous for letting corporate ownership hide behind layers of paperwork. If that pattern holds, the 2026 reforms don't necessarily create a Cuban private sector in the way Vietnam or China built one. They risk creating a system where formerly state-owned assets get relabeled as private while remaining controlled by the same small circle of people, a pattern with an ugly precedent. It's close to what happened across parts of the former Soviet Union in the 1990s, where privatization mostly meant well-connected insiders acquiring state assets at a fraction of their value, producing a new class of oligarchs rather than a genuinely open market. GAESA-linked entities have already shown they can move fast to stay ahead of sanctions. When the U.S. designated the conglomerate's port and logistics arm, the assets were reportedly sold off within days to a newly created company, a maneuver analyst's view as a straightforward attempt to dodge the sanctions list rather than a genuine change of ownership. The reason this distinction matters isn't academic. It determines whether foreign capital flowing into a liberalized Cuba would actually build hospitals, fix the grid, and create jobs for ordinary Cubans, or simply get absorbed by the same elite network that has controlled the economy's commanding heights for decades, just wearing a different corporate label. Here's the part of the story that reveals what the U.S. actually wants from this crisis, as opposed to what it says it wants. For decades, the stated American demand has been economic liberalization, open markets, private property, foreign investment. Cuba has now announced, on paper, close to all of that. Private banks, an open foreign exchange market, no cap on business size, foreign investment without a state joint venture partner. If economic liberalization were genuinely the finish line, this would look like a plausible starting gun. Instead, the U.S. State Department dismissed the package as superficial smoke signals within a day of its passage, and followed up within the week with fresh sanctions on GAESA-linked entities and a family member of a senior Cuban Communist Party official. That reaction tells you the actual American objective was never simply, please liberalize your economy. It's regime change, or at minimum, a level of political liberalization, competitive elections, freed political prisoners, the dismantling of one-party rule, that the current reforms don't remotely touch. Cuba's own president has been explicit on this point too, framing the reforms as economic necessity rather than concession, at one point declaring, in essence, that they weren't being done under American pressure. There's an important investing analogy buried in this dynamic, one that applies well beyond Cuba. Know what the other side is actually optimizing for, not what they say they're optimizing for. Cuba is negotiating as though the U.S. wants a healthier trading partner. The U.S. is negotiating as though it wants a different government. Those two goals produce completely different sets of acceptable concessions, and as long as both sides are solving for different problems, no amount of economic reform closes the gap, which is exactly what's happened here. Reforms that would have been a breakthrough in a purely economic negotiation have been essentially waved off because they don't touch the actual point of contention. Strip away the geopolitics for a moment and look at what this collapse has actually done on the ground, because the numbers are stark enough to stand on their own. Essential medicines are available at roughly 30% of normal supply levels. Tens of thousands of medically necessary surgeries, including thousands involving children. have gone unperformed simply because hospitals can't reliably keep the lights on or the equipment running. Infant mortality, a metric Cuba spent decades bringing down to levels that rivaled much wealthier nations, has roughly doubled. Food production has fallen by more than half relative to a baseline that was already inadequate in a country that imports the large majority of what it eats. And roughly 1 million people now depend on water delivered by truck because most of the island's water pumping infrastructure runs on the same electricity grid that's failing. Layer inflation on top of that. The official exchange rate sits at 24 pesos to the dollar. On the street, the real rate is closer to 450. A carton of eggs in the private shops now doing most of the actual food selling can cost more than a month's government pension. When a currency's black market value is roughly 19 times its official one, that gap itself is a leading indicator economists watch closely. It's the market's real-time verdict on how much it actually trusts the government's own numbers and how desperate people are to get out of the local currency entirely. The response to all of this has been the largest migration wave in Cuban history. The population fell by roughly 1 in 8 people between 2020 and 2024, with surveys suggesting a striking majority of those who remain would leave if they could. That's not a footnote to the economic story. It's arguably the most important data point in it, because an economy's long-run recovery potential depends heavily on its human capital and the people with the skills and option 12. DHE Future. WH at World AC2 EO Recovery requires to leave. Doctors, engineers, young professionals are disproportionately the ones going. So where does this go from here? There isn't a clean answer, but there is a clear list of what recovery would actually require, and it's worth being honest about how far away Cuba currently sits from all of it simultaneously. China has been the most consequential outside actor so far, building dozens of new solar installations that have taken Cuba's share of solar-generated electricity from around 6% to over 20% in roughly a year, with plans to push renewables toward a third of total generation by the end of 2026. That's genuinely significant, but it comes with an important technical caveat that gets lost in the headline numbers. Solar without adequate battery storage only solves the daytime half of the electricity problem. Cuba still needs a fuel-burning backstop for every evening, and it still doesn't have meaningful battery capacity to bridge that gap. Renewable capacity additions look impressive on a percentage growth chart. They don't automatically translate into reliable electricity after sunset. Russia has sent tankers inconsistently. One delivered, one turned back. Iran has offered rhetorical solidarity but has limited spare capacity of its own to actually offer. None of these alternative patrons currently come close to replacing what Venezuela used to provide, and there's a structural reason for that. Venezuela's arrangement worked because it was ideologically motivated and heavily subsidized. Essentially, a below-market transfer dressed up as trade. China, Russia, and Iran all have their own economic pressures and are far less willing to run Cuba's energy needs as a charity operation the way Chavez-era Venezuela did. Meanwhile, the U.S. sanctions architecture built around Executive Order 14404 has been expanding steadily through 2026. New designations against GAESA-linked banks, mining companies, and logistics firms arriving roughly every few weeks, alongside a Supreme Court ruling that stripped Cuban state entities of sovereign immunity protections in U.S. courts. Every one of those actions makes it more legally and financially dangerous for any international company to do business with Cuba, regardless of what Havana's own reforms allow on paper. Put simply, even in the most optimistic, realistic scenario, Cuba needs several things to happen at once that have historically never happened at once. A genuine loosening of U.S. sanctions, tens of billions of dollars in infrastructure investment, the return or replacement of a skilled workforce that is actively leaving, and a domestic political transformation robust enough to convince outside investors the rules of the game won't simply revert once the crisis eases. Cuba's own history, A recurring 30-year pattern of crisis-driven reform followed by reversal once conditions stabilize is the strongest argument for skepticism that this time is fundamentally different. Step back from Cuba specifically, and there's a lesson here that applies to any economy, or honestly, any business, built around a single external relationship. Diversification isn't just a portfolio management cliche. It's the single most reliable predictor of resilience, whether you're looking at a company's customer base, a country's trading partners, or a household's income sources. Cuba has now lived through the exact same failure mode twice in 35 years. Build critical dependency around one committed patron. Watch that patron's own position deteriorate for years while ignoring the warning signs, and then get blindsided when the relationship finally breaks. The Soviet Union's collapse and Venezuela's collapse look like completely different events on the surface. One triggered by the end of the Cold War, the other by a US military raid. But underneath, they're the same story told twice. Concentration risk realized. The other lesson is about the gap between announced reform and structural reform. Markets and analysts love headline numbers. 176 measures, the most sweeping since the revolution, is a genuinely compelling headline. But the real diligence question, the one that separates a headline from a fundamental shift, is always who actually controls the assets after the announcement? In Cuba's case, the answer appears to be largely unchanged. The same military-linked conglomerate that has run the commanding heights of the economy for decades is still running them, just with a fresh coat of private sector paint. Genuine liberalization redistributes control. What Cuba may be doing instead is redistributing the appearance of control, while the underlying ownership stays remarkably static, 90 miles. That's still the distance. It hasn't changed in 66 years, and it won't change no matter what happens next in Havana or Washington. What has changed again and again is who Cuba could lean on to survive that isolation. The Soviet Union, then Venezuela, and now, uncertainly, whatever combination of China, private capital, and its own newly announced reforms it can piece together. The question this crisis ultimately poses isn't really about Cuba's politics. It's about whether an economy that has spent 66 years avoiding real structural reform can build one from scratch at the worst possible moment, with its most skilled people already leaving, while the one country large enough to change its fortunes overnight has made clear that economic reform alone isn't the price of admission. History doesn't offer many examples of countries pulling that off. Vietnam did it, but Vietnam did it gradually, over a decade, without a hostile superpower actively working to prevent it. Cuba is trying to do something harder, faster, and under worse conditions than almost any comparable transition in modern economic history. Whether it works is genuinely an open question. What isn't in question is the price of finding out. Paid right now in blackouts, empty pharmacy shelves, and a departure wave that is hollowing out the island faster than any reform package can hope to rebuild it. If you've watched enough of these videos, you already know the feeling. You come away with a dozen sharp facts, a launch cadence number, a Starlink subscriber count, a rumor about the next funding round, but no real sense of how those facts fit together. That's not a failure of the reporting. It's just the nature of the format. A video can give you a piece of the picture. It can't give you the picture. SpaceX is a genuinely difficult company to evaluate because unlike most businesses you'd analyze this closely, it isn't public. There are no quarterly filings, no earnings calls, no analyst Q&A to sit in on. What exists instead is a scattered trail. Leaked cap tables, contractor disclosures, industry reporting, the occasional filing from a comparable company. Most people never assemble that trail into anything coherent. They just accumulate headlines. That's the gap the complete SpaceX Investor Handbook was built to close. It's not a tip sheet, and it won't tell you what to buy. It's a structured breakdown, company overview, business model, revenue streams, a full section on Starlink's economics, financial analysis pulled from available data and comparable company benchmarks, SpaceX's emerging AI strategy, the competitive landscape against Blue Origin and the rest, a clear-eyed look at the risks, a valuation framework you can actually apply, and an investor checklist to work through before you draw any conclusions of your own. If the videos have been giving you the pieces, this is where you go to see the whole board. The first link in the description will take you there.